Hi, everyone. Well, hopefully take two will work. So we're going to talk about Chapter 8, which is making capital and investment decisions. I've already run through this one, so I'm pro now. What will we be looking at? Well, we showed you how to make capital budgeting decisions using different techniques like net present value, internal rate of return, the modified internal rate of return, payback, average accounting rate. Now we're going to show you how to determine the incremental cash flows. So in prior chapters, you were told, here is the cash flow from this project. Well, how is that determined? And that's the first part of Chapter 8 will focus on that. We're going to go through an example showing you in detail how to determine net cash flows each year from a project. And then we're going to look at some alternative ways of defining operating cash flow. And finally, some special cases with regards to this discounted cash flow analysis. So remember, cash flow is not accounting earnings. Another important thing to remember is sunk costs, so costs that have already occurred that are not because of the project and won't happen in the future. They're forgotten. They don't matter. However, opportunity costs do matter. So opportunity costs are those costs that you're going to forgo to take on this project. So you have to take those into account when you're determining your cash flow. Side effects like synergy, cannibalism, and erosion matter. We're going to talk more about those. And taxes matter. And inflation. So there's a whole bunch of things we have to worry about and things we don't have to worry about. So let's take a look at this. When performing capital budgeting analysis, should we take on this project or do this project? Always base calculations on cash flow, not accounting income. So earnings, remember, do not equal cash. We also need to know the amount of cash for capital spending, the amount of cash for rewarding shareholders. Therefore, capital expenditure analysis must be based on cash. Cash flows, again, is not accounting income, it's not earnings. We need to convert accounting earnings into cash flow. So much of the work in evaluating, I'll get it out, in evaluating a project lies in converting accounting income to cash flow. So we saw some of this in our statement of cash flows from the beginning of the semester. Things like depreciation have no involvement with cash at all. However, we subtract them on our income statement for accounting income. Well, those kind of things are not subtracted to get cash flow. Same with amortization. Now remember, depreciation is the word used to describe the expensing of a tangible asset. Amortization is also expensing, but it's of an intangible asset. So that should be added back as well to accounting income. This should have never been subtracted if you want to know cash flow. There's also deferrals and accruals that need to be accounted for and taken out of accounting income. And these are things that are either revenues or expenses that the cash was not collected yet or paid yet. So any kind of deferrals and accruals in our incremental cash flows must be accounted for. So remember, incremental cash flows arise as a consequence of selecting a project. It seems like a simple task, but not so, because there are many pitfalls in identifying incremental cash flows, and that's what you have to be careful of. So remember, sunk costs are ignored. So it's a cost that's occurred already. you might think it's part of the project, but if it's already paid, it's done, it's ignored. Opportunity costs do matter. So just because a project has a positive net present value does not mean it should have automatic acceptance, especially if another project with a higher NPV would have to be passed up. So we need to take into account what we're giving up in order to do the project we're looking at. Side effects matter. Erosion and cannibalism are both bad things. So what this means is we need to take into account if our new product, this new project we're taking on, causes existing customers to demand less of current products. We need to take that into account and think about that. And it could also cause synergies, which is a positive thing, that this new product will increase demand on existing products. So we would need to recognize that. So we can't just simply say, here's our cash flow and we're done. We need to determine if these kind of side effects are occurring and how they affect incremental cash flows. Another item that needs to be looked at is how much overhead should be allocated to the new product or project. So overhead are things like utility expenses of the warehouse or the production line, rent of the production line. So these are costs that can't be specifically identified with the project, but would be allocated. So we only make allocations if the project itself increases or decreases the cash outlay of the entire firm. So that means these overhead costs would increase. And also, we need to worry about salvage value of assets. When assets are sold at the end of a project, we need to determine the salvage value and assume it's a cash inflow at the end of the project, because we're going to be looking if we should do the project at the beginning, not the end. We're going to have to determine to the best of our estimating ability what kind of cash we could sell that asset for. So there's a lot more involved with our other incremental cash flows than just how much more cash we're going to make just on this project. Another incremental cash flow that must be taken into an account each year is the change in net working capital. Now, remember, net working capital is current assets minus current liabilities. So what new current assets will be created by this project and what new current liabilities? So if the current assets or the net working capital increases, we will need more current assets, more cash flow. Now, what's important is that by the end of the project, that increase in net working capital will decrease to zero. So we need to account for those changes when it comes to incremental cash flows. And we'll see that. Now, how do we estimate cash flows? Well, if you remember, if you take earnings before interest and taxes minus taxes plus depreciation, that will give you cash flow from operations. Interest we ignore because we assume that it will not change. So there will not be any more incremental cash flows from new debt. We just assume that there will not be any new debt in this chapter. And it's just an assumption we're making. We'll see when it changes. Hopefully we will get to those chapters. So that's the background, and you could read through that and get an understanding of it. But if we take a look at a pure example, this will help make all these different items come together, and you'll see their relationship. So here is the example. It's in your book, and it starts on page 231, and the highlights about Baldwin Company. They started investigating the marketing potential of a brightly colored bowling ball. I'm reading this right out of the book on page 232, full paragraph. They sent a questionnaire, they got some results back. And they came to a conclusion that the brightly colored bowling balls could achieve a 10 to 15% share of the market. Of course, some people at Baldwin complained about the cost of test marketing, which was $250,000. That's a sunk cost. That was already spent, and it has nothing to do with incremental cash flows from making the bowling ball. So they're considering investing in a machine that cost $150,000. No, I'm sorry. I read the wrong thing. The bowling ball machine will cost $100,000. They were going to sell and could sell the building, which they were going to make the bowling balls in, for $150,000. And they own that with no debt on it, meaning they own no more, they own it 100%. It goes on to say that the increase in net working capital for time zero would be $10,000. So they would need to buy, they would have an additional $10,000 in current assets. They're going to use the machine for 5 years, and that's the amount of bowling balls the machine will produce. The machine's salvage value, I think this might be on the next one. Nope, it doesn't have it here. The machine's salvage value is $30,000 at the end of its life, meaning they could probably sell it at the end of 5 years for $30,000. Inflation rate is 5%. Working capital, the initial change is $10,000, which we talked about, but then it will be based on 10% of sales. So the working capital needs will be 10% of sales. The price for the bowling ball, so they'll sell it for $20 and it increases 2% per year. It's going to cost $10 the first year to make it, and then those costs increase 10% each year. So out of all of that reading, those are the key points for us to determine should we continue with this project. So this is on page 233 of your book, but I wanted to take a walk through this step by step. Notice we have year 0, 1, 2, 3, 4, and 5. Time 0, that is today. What kind of expenditures will the company have to make? Well, here's your first one. And they took off, it's not in terms of thousands. So I'm going to, that should be $100,000. But because they took them the 3 zeros off in this illustration, I'm just going to read it the way it looks. So $100 for the bowling ball machine. So that is an expenditure that they have to make at time 0. What you have to remember is they are giving up an opportunity cost of selling the warehouse and land or the building and land where they're going to make the bowling ball. So that needs to be taken into account. The net working capital at the end of the year, what are the needs? $10. So that means they have to expend $10 right now for the net working capital. So they have to spend an extra $10 for those current assets that they're going to need. So at time 0, the company, it has to expend $100 for the bowling ball machine. They give up $150 because they didn't sell the property today, and they have to expend an extra $10 due to the change in net working capital. So $260 is the amount of cash flow they have to pay today to get the project started. Now, let's go down to the bottom and take a look at sales, operating costs, depreciation, etc. Each year, the company will have sales revenue based on the number of bowling balls it's selling, which for the first year would be 5,000. They're charging $20 per bowling ball. That is given in the problem. So 100 or 100,000. It costs $10 a bowling ball to make. So 10 times 5,000 10 times, 5,000, so that would be 50,000. Now, we need to calculate depreciation. Now, when you're using and doing a projection, you use tax depreciation. Now, if you're sitting there going, well, I thought you didn't subtract depreciation, you add it back. Well, we need to subtract depreciation to determine how much of the incremental income will be taxed, because that is a cash flow that would not be, it would need to be subtracted. So the first thing we want to calculate is how much depreciation would be subtracted on the tax return. On page 234 is a tax depreciation schedule under modified accelerated cost recovery, or what we call MACRS. You will be given the life of the asset. So you see the columns going across the top. This asset has a 5-year life. Each year, you will use the corresponding percentage for the year of cost recovery or depreciation. So going down that column, year 5, the first year, 20%, 0.2, times the cost. You ignore salvage value. For tax depreciation, we do not take into account salvage value. 100,000 times 20% will give you $20,000 of depreciation in year 1. Go to the next percentage down that column for year 2. 100,000 times 32%, that's where the 32,000 comes in year 2. I'm just going to keep going across. Year 3, 100,000 times 19.2%. Year 4, 100,000 times 11.52, and then the same percentage is used for year 5. So since this is only going to be used for 5 years, you would calculate the depreciation accordingly. So if this was a 7-year life bowling ball machine, you would have used the 7-year column. Each year, calculate the depreciation expense based on the percentage in that column for that year. So let's go back to year 1. So we're going to bring in cash of 100,000 from selling the bowling balls. It's going to cost us 50,000 to make them and sell them. And then there's 20,000 in depreciation expense on the bowling ball machine. Once we subtract the 50 and the 20 from the 100, how much income will be taxed? 30,000. They give us a tax rate of 21%. So 21% of the 30,000 will be 6,300. So how much would our net income be? So right now we're calculating net income, not net cash flow. It would be 30 minus 630 for 2370. Okay. So working capital is at 10. We already accounted for that 10 coming in. The working capital necessary at the end of each year would be 10% of the sales. So we started with 10 and we would need 10 by the end of the year, 10% of 100,000. Up above is how much depreciation would be accumulated each year. So after year 1, we just recorded 20,000 of depreciation. So at the end of year 1, accumulated, or the total amount of depreciation taken so far, is 20,000. The book value of the machine would be the cost minus the balance in accumulated depreciation. And that's how you calculate it each year. Let's go to year 2. Start with sales revenue. That's where you want to start. So this company is in year 2, has 8,000 bowling balls, but now the cost is determined by taking the selling price times the increase of 2%. So if you take the selling price of 20, calculator, have it out, times 1.02, that will give you the new selling price of the bowling ball, $20.40. Oh, sorry, I didn't mean to go forward like that. Let me go back. Okay, $20.40 times the number they're selling, which is 8,000, $163,200. The cost of making the bowling ball started at 10 and it increases 10%. So multiply it by 1.1, that's given. Now the cost is $11 times 8,000 bowling balls, $88,000. We already showed you how to get the depreciation. So the selling price, the total sales, minus the operating cost, minus the depreciation gives us income before taxes. Multiply that number by 21% to get the income tax that will be paid on that income. Subtract that income tax from income before taxes to get net income. Remember, that's accounting income. We'll get to cash flow. We just want to do this calculation first. Net working capital needs, what will we need at the end of this year? Well, 10% of the sales, so $16,320. So we will increase our net working capital needs by $6,320, from $10,000 to $16,320. So that's where the $632 comes from. So an additional $6,320 will have to be spent on an increase in assets, current assets. The accumulated depreciation last year was 20. We added another 32 of expense this year. So the new balance at the end of year 2 is 52,000. 100,000 minus 52,000 gives us a book value of 48,000. Now, the importance of doing this calculation at the top, you'll see at the end of the life of the asset. Next year, start with our sales revenue. So last year's ending selling price is $20.40, right? 20 times 1.02. Now multiply that by 1.02 again. So now it's $20.81 times the number of bowling balls, 12,000. So 249,000, and it's rounded in here. It's supposed to be 696. They rounded it to 249,700, and that's fine. Now take the $11 that it cost last year to make the bowling balls and multiply it by 1.1 because there's a 10% cost increase. So the new cost to make the bowling balls is $12.10 each, times that by the 12,000 bowling balls, total cost, operating cost, $145,200. We showed you the depreciation calculation. It's 100,000 times the percentage for the third year of a 5-year asset, 19.2%. Subtract the operating costs and depreciation from the sales revenue to get your income before taxes. Multiply that by 21% to get the income tax on that money. Subtract that from the 8530 to get net income. Net working capital needs for the end of year 3 will be 10% of sales revenue. So 24,970. An increase of $8,650. Since the working capital needs increased, that means we'll be spending more money for more assets. 8,650. Accumulated depreciation at the end of year 2 was 52,000. We just added another 19,200. So now it's at 71,200. 100,000 minus 71,200 gives us a book value of 28,800. Do the same thing for the 4th year. I'm going to hop to the 5th year though. In the 5th year, we need to determine our new selling price, which I'm going to start over. So it increased once to 2040 in year 2. Then it was at $20.81 for year 3. Then we multiply that by another 1.02. So I'm getting $21.22. Multiply that by the 6,000. Oh, wait, I think I need one more. Yeah, okay, I did that wrong. So 20, year 2, it was at 2040. Year 3, 20.81. Year 4, 21.22. Now year 5, $21.65. So if you multiply the $21.65 new selling price by the 6,000 bowling balls in year 5, you get $129 I got 900, so I'm off a little bit. The operating costs started at $10 in the first year. Second year, they went up to 11, another 10%. Then the third year, they were at $12.01. The fourth year, another 10% increase, $13.31. And then finally, the fifth year, they're at $14.64 each, times 6,000, 87,846, and they round it. The depreciation was calculated, so we subtract the operating costs and depreciation. Income before taxes, 61,620. Multiply that by the 21% tax rate to get 6,410. Subtract that from income before taxes to get net income. Whew. Now, at the end of year 5, there is no more net working capital needs because we're done with the project. So the net working capital need goes to 0. So that means there's an increase in cash flow due to the decrease in net working capital needs. It goes down to 21,220. Well, it decreases by that much. So that's actually an increase in cash. In the final year, the accumulated depreciation is now at 94.24, which means the book value would be 100,000 minus $94,240, or a book value of $5,760. Now, what is that little asterisk up at the top? Well, what are we going to get in year 5 for that bowling ball machine? $30,000 cash. If we subtract 5,760 from that, the book value, it tells us the gain on that equipment. Okay, that gain must be taxed. $24,240 is the gain. You should then multiply that by 21%. So the tax on selling that bowling ball machine, the tax on the gain is $5,090. So we received $30,000 cash, but we have to pay $5,090 in taxes. So how much cash is there from selling the bowling ball machine after we pay the income tax? $24,910. So that's where the $24,910 is coming from. Again, selling it for $30,000 cash, we need to calculate the gain. And the gain is the difference between the selling price and the book value when you sell the bowling ball machine. So 30,000 minus 5,760. That entire gain is taxed at 21%. Stop. Sorry. My dog barks 5 times a day. Right now is one of them. 30,000 then is how much cash was received, but 5,090 would have to be paid in taxes. So the difference is how much cash they will have left after paying the taxes on the sale of that machine. So we got all of our information here. Finally, in year 5, we could sell that warehouse for 150, and that's the assumption. Now there is an assumption here. All cash flows occur at the end of the year. All amounts are in thousands. As I said, we dropped all the 3 zeros there. Now, let's take a look. We're just showing you again how we can calculate all of these amounts in the sales revenue and then the operating costs. And I went through that. You can go back and take a look through it. Make sure the bear isn't out there. Okay. There's the depreciation calculation. That should say makers, M there. If that's not acres, that should be makers. And that's just they're isolating that year 5 column so you can see where all those percentages are coming from. Remember, you'll be told the life of the asset. So now let's see what the cash flow actually is. All right. And this is on my glasses, the bottom of page 235. So now what are the incremental cash flows? Well, we already determined at time zero, when we take on the project, we're going to have to expend $260,000. How do we get operating cash flow? Well, we said you can take earnings before interest and taxes, subtract taxes, add depreciation. Or here's another way. Take sales minus operating costs minus taxes. Depreciation has nothing to do with cash, so it shouldn't be subtracted to get to cash flow. It's subtracted to get to income to determine income tax. So total cash that will be positive, $43,700. End of year 2, take the sales revenue you calculated minus the operating costs minus the taxes. Now we'll need an additional $6,320 in net working capital requirements. So we'll subtract that. So the cash, positive cash, $59,810. Same thing with year 3. Now in year 4, our net working capital requirements causes us to have a positive cash because we don't need to buy more assets. It actually decreases. Now let's take a look at year 5. Here's our sales in cash minus our operating costs minus our taxes. Where does this 196.13 come from? Let's go back. Oops. I just want to get back to the right one. So there's our original analysis. Here's what it is. It's the $24,910 from selling the bowling ball machine and after we paid the taxes. The $150,000 when we sell the warehouse. Okay. And the positive cash from the decrease in net working capital. So that money will come back to us. Those 3 amounts added together gives us 196.13. So the total cash flow for year 5 will be 231.77. So that's how we get to the incremental cash flows. Now, you know the rest from prior chapters. Calculate the net present value. Take the initial investment, negative 260, and then determine each cash flow's present value. So in year 1, of course, it would be 4370 divided by 1.10. But in year 2, 5981 divided by 1.10 to the second power because our discount rate is 10%. Here, up on the corner here, they're showing you the different net present values using different rates. So the internal rate of return for this project would be 18.54. That's the point. Net present value would be 0. But in this case, at 10%, it's at 78,530. It's a positive, so it would appear we would accept this project. So that's how we take on determining if we should, or first of all, determining cash flow, incremental cash flows to put into our net present value calculation. So here they're just showing you some calculator stuff. Next. So inflation is an important fact of economic life and must be considered in capital budgeting. Remember, 1 plus the nominal rate equals 1 plus the real rate times 1 plus the inflation rate. That's the Fisher effect. For low rates of inflation, we can approximate the real rate by taking what's being charged, the nominal rate, minus the current inflation rate. So while the nominal rate in the US has fluctuated with inflation, the real rate generally stays about the same. So in capital budgeting, you must compare real cash flows discounted at real rates. So cash flows without inflation using real rates, or you're going to use cash flows with inflation discounted at nominal rates, those with inflation in them. You got to keep that in mind. When you are determining operating cash flows, there's more than one way. We showed you one, net income plus depreciation. And you could do this when there's no interest expense or it remains constant. So it's not going to incrementally change. But there is another top-down approach to determine operating cash flow. Do what we did also in this last one. Take your sales minus costs that are cash related minus taxes. So no depreciation there. Ignore depreciation or amortization. There's also the tax shield approach. A little different. Just showing you different ways. You choose which one you like best. Sales minus cash costs times 1 minus the tax rate. So 1 minus the tax rate is the amount of those items that you'll have left after paying taxes. Add to that the amount of tax savings from deducting depreciation. And you find that by taking depreciation times taxes, tax rate. So depreciation you could deduct, so you have a tax savings from it. If you multiply that by the tax rate, that's how much money you will save from calculating tax on depreciation. So we add that cash back to our first part of the formula, and that's our operating cash flow using this tax shield approach. 3 different approaches. You pick which one works for you. Some cases we have special situations. Companies often need to submit a competitive bid to win a job. And there's something called the winner's curse. And they say, if you win, you probably have underbid the job. So we want to try to bid our jobs to avoid this type of curse. We take we have to look at incremental cash flows, but we really have to determine what's the proper charge for the project. So let's take a look at an example. You are in the business of buying a stripped down truck platforms and modifying them for resale. You need 5 trucks per year for the next 5 years. You need $60,000 in new equipment straight line depreciation to 0. It will be worth $5,000 at the end of the year 4. Net working capital needs are $40,000. You can buy the platforms for $10,000 each. Facilities needed can be leased for $24,000 per year. Labor and materials costs are $4,000 per year per truck. So a whole bunch of information, and I believe this one is in your book on page. Oh, there we go. It is on page 244. So the first thing you want to determine is how much is this going to cost? So it first says to us, well, first of all, we know we need to pay $60,000 right now. And this will have a salvage value, so we'll be able to recoup $5,000 at the end of year 4. We're going to need $40,000 in current assets. So we're going to have to expend an additional $40,000 in year 1. The platforms cost $10,000 for each truck. So there's the $10,000 in our first formula there. The facilities will be $24,000 per year. So that's a fixed cost. It doesn't change with the number of trucks. But the $10,000 and then labor and materials are $4,000 per truck. So $14,000 per truck, 5 trucks. Multiply that out, add the $24,000. So the total cost per year, $94,000. Our tax rate is 21%. and our required rate of return is 20%. So let's determine, first of all, year or time zero. What do we need to expend? We need to expend $40,000 for net working capital and $60,000 for the equipment. So 100,000. We need to have positive cash flow in year 1, 2, 3, and 4, the same amount. At the end of year 4, we'll get our $40,000 back that we invested in net working capital. And we will have positive cash flow from the sale of our machine here. How much? Well, we will calculate depreciation of the full amount. We'll depreciate or expense this, all $60,000 that we paid for it. So if we sell it for $5,000, the gain is $5,000. There's no book value. Times 21% gives you $1,050 in tax. So of the $5,000 cash they'll receive, $1,050 will have to be paid out as tax. So the positive net after-tax cash flow from selling that will be $3,950 positive. So find operating cash flow when your NPV is 0. You want your net present value to be 0. How do we do that? Well, first, take the $100,000 that we have to expend today, subtract it from the present value of the future cash flow we know. So the future cash flow, positive $43,950, divided by 1 plus the required rate of return. And since this is cash flow in the 4th period, to the 4th power. So the operating cash flow for an NPV of 0 would be $78,805. Now, we still didn't get our payment amount. That's the total amount we would need, $78,805. So the present value of a annuity, because remember, we want the same amount of payments or operating cash flow each period for 4 years. So how much operating cash flow should we receive? And you can find that by saying, well, present value is $78,805. I'm going to use my calculator. I'm going to go in my apps, my finance. My N is 4 payments. My I is 20. My PV, I'm going to put in as negative $78,805. And I'm going to solve, go down and solve for my PMT, $30,442. So that's the amount of operating cash flow that will make my net present value 0 with a 20% rate of return. But that's not what our bid price is. That's just the cash flow we need. Now we need to take an extra step. And then we're kind of working backwards here. Now, net income will be operating cash flow plus depreciation. Remember, depreciation, 60,000, 4 years. So 60,000 divided by 4, they told us to use straight line, would give us 15,000 of depreciation each year. That should be minus. So 30,442 minus 15,000 will give us net income of 15,442. So how much sales do we need? Well, if net income is 15,442 and depreciation is 15,000, okay, costs are 94,000 each year. How much sales and how much would our taxes be? Well, here's what you do. Sales minus costs minus depreciation times 1 minus the tax rate equals $15,442. So 1 minus 21%, 79% of those three items is how much net income would be. So sales minus 94 minus 15 times 1 minus 0.21, then solve for sales. So your sales need to be at 128,546 each year. So how much bid for each truck so that your sales amount is 25,709 per truck. So be careful. Don't just use operating cash flow because it hasn't taken into account taxes or depreciation. You need to determine how much sales, how much revenue do I need to charge? And that's different than operating cash flow. Finally, there are times when application of the net present value rule can lead to wrong decisions, especially when you have unequal lives of two choices. So here you have a company that they want to consider a factory that must have an air cleaner that is mandated by law. They could buy the Cadillac cleaner, which costs $4,000 today and has annual operating costs of $100 and lasts for 10 years. Or they could buy the cheapskate cleaner, which costs $1,000 today, has annual, operating costs of $500 and lasts 5 years. Well, you're comparing apples to oranges here. You're comparing one that'll last 10 years and one that'll last 5. So if we just say, well, that's okay, we'll assume a rate of return of 10%, which one should we choose? Well, if you put those factors into Excel or into your calculator and calculate net present value, it'll appear that the net present value for the Cadillac air cleaner is negative $4,614.46. Where the cheapskate cleaner, giving its variables, has an NPV of negative $2894.39. So it would appear that the cheapskate cleaner has the higher NPV because it's the lower of the two negative numbers. But does it? When you have unequal lives, you have to incorporate that into your calculation. So there's two methods of doing that. And the first is called replacement chain. So you repeat the projects until they begin and end at the same time. And then you compute the NPV for the repeated projects. That's one way. The other is calculate what we call the equivalent annual cost and then determine which is better. So if we take that approach, here's the Cadillac cleaner and their timeline of cash flows. 10 years, $100 a year, $4,000 initial cost. We're going to do the same thing with the cheapskate cleaner and continue those annual payments of $500. I don't know why that 1,500 is there. It should be 500. Oh, I'm sorry. Yes, I do know why. Because we would have to expend another $1,000 in year 5 for another cheapskate cleaner. So now if we compare the net present value using an equal timeline, 10 years to 10 years, and they're replacing that cheapskate cleaner again in year 5, now look at our NPVs. Negative 4614 for the Cadillac, cheapskate, negative 4693. So the replacement chain approach helps us really to compare because the timelines are the same. So now it would appear that the Cadillac air cleaner is the better choice. Equivalent annual cost is an annual annuity payment implied by a project's net present value. So what we do is we take a look and we look at a project's net present value and we say, well, if we receive that amount in payments, what would the payment be? Or if you want to look at it, if we had to pay for that monthly or at a certain time periods, what would in this case, an annual payment be? You should use the same term and rate as you do for the net present value. So if we were looking at it for the Cadillac, use the net present value, 10 years, and I think it was 10%. The annual payment for that would be $750.98. Do the same thing for the cheapskate filter. The annual payment would be calculated as $763.80 using its NPV, 10 years, 10% rate. So it's just showing us a different approach and maybe one that makes, you could look at it and explain it a lot better to someone than maybe net present value. You can say, if we had to pay for this monthly, it would cost us $751 if we got the Cadillac filter, but the cheapskate filter costs $764. So it makes more sense to use and get the Cadillac filter, even though the initial cost is higher. Long run, it will be more efficient for the company to buy. So again, there's how you can put information into your calculator for this. And I believe this is reviewed in your book as well. And you know how to do that in Excel by now, right? Okay, so in the last slide or two, the cleaners in the previous example were both new machines. However, often companies must decide when to replace an existing machine with a new machine. You should replace if the annual cost of the new machine is less than the annual cost of the old machine. Again, you could use that equivalent annual cost to make that decision. And there's some great examples in your book that you should run through. And then ask any kind of questions you may have related to them. But that's the key. So there's a quiz question or two, but hey, I got through it. Hopefully you won't have any issues with listening to this one. And please post any kind of questions you may have on the discussion board. Again, the core part of our discussion was determining incremental cash flows on projects so that we can apply our net present value analysis. We looked at unequal lives, and we looked at competitive bidding and how to set the price appropriately for those types of projects.